If you hold a portfolio of crypto, Bitcoin, bloody, I don't even know the names of them, Ripple, some of those major ones, crypto-backed loans. This is a deep dive into crypto-backed loans, so you're not going to want to miss. Do not do it to yourself. Borrow against your crypto without selling it. Understand why the last wave of crypto lenders fail and how this structure is built differently, presented by gapfunded.com. Let's bear up it. Borrow against your crypto without selling. Why the last wave of crypto lenders blew up and how this one is built differently. Keep your position, keep your upside, access the liquidity you need without triggering the sale. So why the last wave blew up. Celsius, BlockFi, Voyager, all gone by the end of 2022. The collapse wasn't random. It was structural, ladies and gents. So re-hypothecated collateral. That's a big word. Customer crypto was lent out again or deployed for yield instead of sitting untouched. No real segregation. Pledged assets weren't cleanly ring-fenced away from the platform's own balance sheet. And the opaque risk. Nobody outside the platform could see how exposed the collateral pool actually was until it was too late. Contagion in 2022, Terra, Luna, and 3AC collapse exposed all three platforms in the same few months, freezing withdrawals. Now, here, how this is structured differently. Same idea, borrow instead of sell, very different plummet. The old model, Celsius, BlockFi, Voyager, collateral pooled and re-lent, full recourse to a platform, not a bank, risk hidden inside the platform, no independent custodian. Essentially, it was a bloody scam. This structure, non-recourse, regulated custody, assets held under a control agreement, non-recourse, never a personal guarantee, regulated custodians, not the lender itself, and no movement except as loan terms allow. So, what a crypto-backed loan actually is. Pledge the asset you already hold, borrow against the value, never sell. Pledge, don't sell. So eligible, publicly traded crypto is pledged as collateral with a regulated custodian. No coins are sold. Cash advance. A lender advances cash against the pledge value. You receive liquidity without liquidating your position. So you're keeping the upside. You retain the asset and every bit of the upside if the price climbs from here. And there's no tax event because nothing was sold. No capital gains are triggered until you choose to sell, if ever. Now, what a crypto-backed loan actually looks like on paper and how it frees you up to go and tackle other investments while your crypto sits with the upside or downside. It's a 75% max LTV, depending on liquidity, volatility, and trading history. 1.5 to 7% annual interest only, typically paid quarterly. Up to 500 mil max loan size, loans from 50K up to 500 mil and beyond. 10-year max terms of 3, 5, 7, or 10. Non-recourse throughout, and there's no FICO exposure, no credit check, entirely collateral based, similar to the stock-backed loan. Here's the honest risk conversation. Volatility is real. Here's exactly what it means to you. So margin top up. The price drops past agreed thresholds. The lender typically asks for a top up, more crypto or cash to rebalance the position back to a safe level. So a non-recourse protection, if a top-up isn't made, the lender's remedy stays limited to the pledged asset. It never becomes your personal debt, and they can never go after your personal assets. That single line, non-recourse, is what separates this from what happened in 2022. So a quick example, illustrative figures. Not a real client, starting position, 500K in eligible crypto at 35% LTV. You sell the crypto, capital gains tax due on the sale, cash in hand once, zero exposure to future upside. Borrow against it, on the other hand, roughly 175K cash in hand, no sale, no tax event, full upside on the position, retained. Now that's a non-recourse throughout the term, meaning the only exposure is either your top up or they take your crypto. Who this is for, eligibility, and who it isn't. Worth being straight about both. So ideal for holders of established, liquid, publicly traded crypto, think Bitcoin. Positions that clear a minimum daily trading value test. Serious holders who don't want to break a long-term position. It's not ideal for speculative, low volume or low cap tokens. Meme coins, for example. Anyone unwilling to place assets into custody for the long term, anyone looking for unsecured financing. How it works. Inquiry to funding, typically 5 to 10 business days once complete. So share your basics, you go through screening, you get your terms, your underwriting and know your customers done, and then you move to custody. The process is designed to move quickly, digitally. Most of the timeline depends on how promptly documentation and asset details are provided to the borrower. The choice, you don't have to break your streak. To get liquidity out of your holding, you have two paths. You can sell it, cash locked in, upside forfeited for good, taxed on the way out. Borrow against it, upside retained, tax deferred, non-recourse throughout, built for holders who take their position seriously and actually have faith in the upside, not a platform chasing yield with your collateral. Now, find out what your position could unlock. Talk to Get Funded about securities financing. The application's straightforward. Share your asset, quantity, exchange, or venue, and approximate value to get started. If you're ready to explore that, visit gapfunded.com/apply to begin your inquiry. It's a regulated custody. Your assets are held by a regulated custodian under a control agreement. Non-recourse, never a personal guarantee. Your liability ends at the pledge collateral. And it's fast funding, 5 to 10 business days, typically from confirmed underwriting to cash wired. So head to that link below, apply at gapfunded.com/apply. And worst case, you walk away with a game plan, a couple of steps, and maybe a couple of other options. Now, I'm Mick Watley, founder of Gap Funded. If you adored this video, go down the bottom, smack subscribe, flog the bell, and I'll see you on the next one.